Hi, I'm Steve Neal, and this is Timbo. And thanks for joining us here on A Catastrophic Event for the third part of my interview with former investment manager for Spokane County, John Christina. Today we dig deeper into rate cuts, the CPI, and things to consider when investing.
And there's all different kinds of risk out there. I mean, you've got, the risk of market risk. You have sector risk, where certain sectors, if you invest too much in one area, you've got geopolitical risk if you're investing overseas. You've got inflation risk if you're investing in cash and money markets. So there's all different types of risk out there. Safe market is relative. It depends on what you're comfortable with, but there is always risk involved in any type of investment. Now, the other side of that coin is you're hoping there's going to be a good return for that investment.
So, I guess looking at that, theoretically, the higher the risk, the more the return.
Right.
Or at least that's what you would hope.
Right.
And I mean, there's always that possibility that, you're told the risk is here, when in reality the risk is
way higher,
way up here. If the thing is honest at all, then you would hope that the risk is relative to the return.
Right.
So basically, what you need to do is really research where you're investing your money.
Oh, it's critical to research where you want to invest your money. And if you don't have the time to do that, then definitely seek out a financial planner or retirement counselor, someone who can help you out. They will actually do a profile where they'll take a look at, okay, what is your risk tolerance? Are you an aggressive investor? Are you moderately aggressive, conservative, somewhere in between? And also based on your time horizon. Do you need this money right away, or is this for retirement? And if it's for retirement, do you need a little bit of it when you first retire, say, to pay off a mortgage? So all those factors come into play. And the other thing is asset allocation. It's being able to spread out that risk. If you have, say, an aggressive investor, chances are, and let's say they invest in a mutual fund, chances are they're going to have an investment split within that investment of maybe 75% in stock and maybe 25% in bond. And that may be even a moderately aggressive investor. An aggressive profile may be 100% in stock, depending on what's out there. But that is why you pay the mutual fund managers to make those determinations for you. They're trying to get you the best return because it's also in their best interest as well as yours. So it's win-win.
Oh, I see. Okay, that makes total sense. Because the better their return, the better they look, so more people are going to jump into that fund, and the more profit they will make personally, and their company will make, or corporation, or whatever it is.
Precisely. It's win-win.
I see. Yeah, that makes sense. You kind of skimmed over that, but what are some of the things that people need to consider investing? What do you look at when you're investing?
Okay, that's a great question. Well, I think the first thing is that you have to have the basics out of the way, Steve. Before you even think about investing, you want to make sure that you have a fund available, so in case emergencies come up, you can cover that. A lot of financial planners will tell you its optimum would be to have about 6 months worth of expenses saved up before you start investing. So in case anything catastrophic happens, like you lost your job, whatever, you would at least be able to get yourself through that period at least part of the time. So that's really important. The other thing is looking at your time horizon. That's a really big thing. Do you need the money right away? Is it for retirement? And so those are two of the critical factors there. I talked earlier about asset allocation. That is another factor in terms of where you're going to invest. Basically, there are three main financial assets. There's stocks, and there's bonds, and there's cash. Now, stocks are just basically shares of ownership in a company. And bonds are basically IOUs that are issued by governments or corporations to fund projects, et cetera. And then you have cash equivalents. And there's usually an inverse relationship between stocks and bonds. Usually if the stock market's up, the bond market's down. Okay? If the stock market goes down, usually the bond market goes up. And if both of them go down, usually cash goes up. If you remember back in the late 70s where you could get 8 or 9% on your savings account.
Oh yeah, it was. Yeah,
Yeah.
I mean, interest was or it was 20 something,
Yeah.
or right at 20%.
Yeah, that was the result of the stagflation that we had there. The stock market wasn't doing well, the bond market wasn't doing well, so cash was king, and that's where people put their money. I mean, CDs were just incredible. You could get incredible returns on your CDs.
Yeah, Paul Volcker
Yes.
wasn't playing games. I mean, he wanted, for better for worse, you could say that he saved our currency after what happened in Vietnam. The guns and butter.
Right.
So yeah, it was Faulkner
Yeah.
who raised it up, and people were screaming and all that. I mean, I remember when we bought our first house back in '80, I think it was '89. My interest rate was nine something percent, and there was a lot of people going, "Wow, that's really good interest rate," because they had been paying 14% or 15% on that on a house, but. Also remember, my first house was $36,000.
Exactly. Yeah.
And so that's one of the big things that's different today is 7% interest in reality is very reasonable.
It is.
On a debt. The problem is 7% on $100,000 for a house or 7% on $450,000. I mean, that's, like I said, my house right now is worth $450,000 or something. Well, I paid $97,000 for it.
Right.
And so, at that time, I think it was 7% or something like that. So I paid 7% on $97,000, whereas now you're going to pay 7% on $440,000.
Exactly.
Same house. The only thing that changed was my age.
Yeah. Yeah. Volcker did a great job on that because we were really, like you said, we were in perilous times back then. You remember that President Ford had whip inflation now. They were trying to do that. Nixon had wage and price controls. There were all kinds of things they were trying to do to take hold of the economy, but Volcker just really nailed it. I mean, he said, this is what we're going to do. We're going to raise interest rates and make it harder to borrow, and et cetera, et cetera.
Right.
And that kind of got the market whipped into line again.
That brought inflation back into, because like you were saying, inflation is where the government prints all this money and it's in search of all this stuff. Well, inflation, or what Volcker did, was made it so hard to get that money out there that they didn't have the money to buy stuff. So the inflation went down, and that bought us, basically a lot of time. But the can has been kicked plenty.
Kicking the can down the road, exactly. And that time when we went through a period of very, very low interest rates for mortgages, that really it was frustrating. My first house, so I think we paid 7.5% interest on it, and we had to put 20% down.
Right. Yep.
You couldn't do that today. It's hard for young people coming up to come up with 20% down on a home.
Right.
And when you consider it, and I think that's why a lot of them were renting.
Right.
Or staying at home with their parents.
Well, when I think it's 60%, don't quote me on that, but I think it's 60% of our country can no longer afford a $400 accident. If something comes up and they don't have $400 in the bank to pay for it. And how in the world are you going to come up with, 20% on $450,000? What is that? $90,000.
Exactly.
If you don't have $400, you certainly aren't going to come up with $90,000.
Right.
And I don't think you're going to be able to tap the bank of your parents for that much money.
Yeah, the first bank of mom and dad.
Right. Yeah. This branch is closed, baby.
Yeah, yeah, and the thing is really tough because, in order to save that, most financial planners will tell you try to save as much as you can, but even if it's just a little bit every week, even if it's just $5, just put the $5 away every week, and eventually it's going to build up over time. It's going to take a long time. But when you have discretionary income, there's a concept out there back in the 80s that said pay yourself first.
Oh.
So you're working hard for your money, and before you start paying all your bills and everything else, pay yourself first. And one of the best ways you can do that is take some money and putting it into a savings account just to build up that nest egg so that if something happens, you can cover yourself.
Right, that makes total sense. And again, I mean, if you want to be able to buy a house, that's the only way you're going to do it. You have to have that money for down payment, and you're going to have a lot of money now.
Yep.
And I don't know where they get this statistic, but I read an article the other day and slipped my mind on what, but to live comfortably in America today, a family of 4 has to make $170,000.
Incredible.
I don't know who makes that kind of money. I've never even. I mean, to me, you're talking professional level stuff: doctors, lawyers, politicians.
Yeah.
People who are able to, get big paychecks. That's certainly not the average Joe. I mean, maybe a longshoreman, but that's certainly not the average guy with, working on the road crew or something like that. And so I guess the rest of us just aren't living comfortably anymore.
Yeah, it's tough. And for young folks coming up that even if they do make a lot of money, it's still hard for them to make that payment. Right. When you consider the cost of the house, the cost of financing the home and everything else, I mean, really what people have to do is just say, okay, how much of a monthly payment can I afford? And then kind of work the numbers backward to work into the house that you want to get at, because you've got taxes, you've got the house itself, and you've got the mortgage payments.
And you got insurance.
Insurance on top of it, yeah.
I mean, like I said, my insurance went up $80. Ow! So the experts tell us to buy in the dip and buy a house today. Mm-hmm. Are there any factors people should consider before taking that advice?
Well, buying on the dip is historically what happens if you have different market cycles. Markets go up and markets go down. And when the market goes down, they call that the dip. And you want to try to buy at the lowest point, which is great investment advice. You want to buy low and sell high. That's classic investment advice. The hard part is trying to determine where that low point is, okay? Because we don't know how long or how low a market's going to go. I mean,
right.
You could be like trying to catch a falling knife, by waiting around waiting for it to happen. But I think that when someone sees, say, the housing market going down, then you get into the affordability aspect. Okay, so the market's gone down 20%. Instead of a $440,000 house, it's down to, say, $380,000. Can I afford that? And you do the calculations. And most financial planners will tell you that your housing cost should be anywhere between 25 and no more than 40% of your take-home pay that you take home. So, I mean, when you start figuring that in there, it makes it, pretty challenging.
Oh, yeah. Yeah, I know, people who, like my son rents a one-bedroom apartment, and he pays $1,200 a month. Mm-hmm. Ow! Yeah. I mean, he makes really good money, he works for a good company and whatever, or what I would consider good money. But, he has a hard time paying that. Yep. And $1,200 is, I hate to say it, is chicken scratch compared to a house. Yep. I mean, if you're going to buy a $440,000 house, what would the payments be on a house like that? $4,000?
It'd be way up there. Yeah, I can't crunch the numbers in my head, but it would be a huge, huge monthly payment.
So he makes good money, and he can't. He's stressed paying $1,200 a month. Well, he's certainly not going to pay $4,000.
Right.
And that's why you have these crazy loan agreements where people, 2 or 3 families will go in and take out a loan. You're thinking, okay, that's going to work real well. Yeah, and in places like Japan, I mean, they have generational buying where house has been in the family for years and years and years, and so within that household you have the grandparents, the parents, and the kids.
and it continues on, we may see that coming here. I mean, we
Right.
already see a lot of folks that can't afford a house that are or a rent, and they're staying with their parents, and
Right.
it's a sad commentary on the times that we're in.
That's the way it was. In fact, when I was in high school, we had a foreign exchange student, and she was over from Belgium. And when I was in the Army, way back when, I went over and visited her and her family, and that's exactly what they had. They had a 3-level house. The the main breadwinner, the guy, basically they had a shoe shop in their house, out of their house, and so mom and dad lived that level, and then Hilda and her siblings were in the middle layer, and grandma and grandpa were in the top layer. And when grandma and grandpa died, mom and dad would move up, and Hilda would move down, and her family or whatever taking over the store. And that's the way it had been done for centuries.
Exactly.
And I think I do believe you're going to see that here.
I think we will, and I think it makes sense to do that, particularly with the economy the way it is. What I see as a hindrance, and again, getting back to politics, is will government policy allow you to do that? If you live in a suburb, will they allow you to have a business working out of your home? I mean, those are things, as much as we don't like to talk politics and economics are so intertwined.
Right.
It's hard not to talk about it.
Right, exactly. And, one of the things that they're doing too is they're changing zoning laws for like apartment complexes and things in single resident housing areas, and they're doing that all over the country. So, like in my neighborhood, there's property that has been there forever. It's basically an entire lot that this family owned, one entire block. And they own one block, and then they own half the other block. Well, that was just sold, and so those, even though it's a residential area, single housing, they're considering putting in apartment complexes or quadplexes or whatever, so they can change the zoning laws to get more people into a smaller space.
Yep. Stack them and pack them.
And it's like, really? But yeah, I mean, they're doing that too. So on a final question here, should people consider buying assets instead of stocks? And if so, what kind of assets do you think they might want to consider?
Well, I think the best thing, Steve, is to have a diversified approach to investing. You've probably heard the phrase, you don't put all your eggs in one basket. I think the best way to survive an economy, any economy, particularly the one we have now, is to spread that risk out over a number of asset classes. We talked earlier about stocks and bonds and cash being the 3 financial assets that we invest in primarily. But you can also consider other things out there, real estate. And if you can't afford, real estate, you have a mutual fund out there for real estate called a real estate investment trust, where you can buy a share of a company that invests in real estate. So you can take advantage of the returns without having to worry about owning the property.
Oh.
Yeah. So that's one area you can go. Another area, of course, is commodities. And, we talked earlier about it, the stock market's down, the bond market's down. What happens if all 3 of those financial areas are down? Stocks, bonds, and cash are all down. Where do you want to put your money?
So is my frown.
That too. Yeah, it's going to get better in a minute. I'm going to make you a happy person.
You're going to cheer me up?
Yeah,
Okay.
I'll cheer you up. But there are a lot of commodities out there. One of the ones that we talk about a lot are precious metals. I look upon precious metals not technically as an investment. I look upon it as a hedge. That when everything else goes south, gold historically proven to be an asset that holds its value. And an ounce of gold back in Roman times will buy you just what it does today.
Right.
It's really held its value really well. So you've got gold and silver and all those other precious metals out there. You can also invest in agricultural products. You have the Chicago Commodities Exchange where you can purchase things like pork bellies and orange juice and things like that.
What do you mean you can purchase?
You purchase shares of, or actually futures contracts for, orange juice
Oh, really?
Yeah, oh yeah. Yeah, it's the Chicago Commodities Exchange.
I never heard of that.
Yeah, well, I can get some more information on that.
Oh, that'd be great.
Yep. And then the other thing is, in a situation like we're in now, it's always good if you can buy more food. What I call beans, bullets, and Band-Aids. You've probably heard Patriot Nurse talk about that.
Right.
But beans, bullets, and Band-Aids. If everything is down, you can't harm yourself by buying more food or buying more medical equipment and supplies. That'll help you in the long run, because particularly in an inflationary environment, what you buy today is going to be a lot cheaper than it will in the future.
Right.
So instead of going to the store and maybe you only need a 5-pound bag of sugar, maybe you should think about getting a 25-pound bag of sugar and then storing it. So it's things like that that can be very beneficial. But other than that, there's some other exotic investments out there that I really don't know a lot about. I haven't done them. There's talk about collectibles and tangible assets. You can even invest in wine and whiskey. Something I may have to consider that.
Just to handle the day.
Yeah, exactly. And then there's other alternative investment out there, but these are for more sophisticated investors. You've got private equity, venture capital, hedge funds, things like that. But for people who are just starting out, I think the best way to go is if your employer has a retirement plan like a 401k if you work in the private sector, or a 457 plan if you work for the government, or a 403b plan for people working nonprofits, is to try to contribute to that, particularly if they offer a match.
Okay.
And always, always, always take the match. That's free money. You can't pass that up. So let's say you put in as little as $10 a pay period. Well, your company or your government agency is going to match that. You've already got 100% return.
Right,
on your
exactly.
money.
Plus
So
whatever
using their
interest
money.
rate.
Exactly. So you always want to do that. And that's probably the best way for people to start. And again, most of those companies have retirement representatives, counselors, financial planners who can sit down and talk to you and kind of guide you through that process and get you into the right investment.
One example that Lynette Zhang has given numerous times, she's done tons of research on this kind of stuff, and she points out, in the Roman times, if an ounce of gold would buy you a set of armor,
Right.
like of the full meal deal. And in the Middle Ages, it would still buy you a really good quality suit of armor.
Mm-hmm.
Well, at the turn of the 20th century, at 1900, if you went out and you bought a really good quality suit, it was about the same price. I think price of gold at that time was $27.
Something like that, yeah.
And a suit of gold, a good quality suit was about $27. So you go out today and the price of gold is $2,300.
About $2,300, yeah.
Well, amazingly, so is the price of a good suit. And so basically, gold has not gone up or down.
Right.
It's just stayed right with the times. So your currency's the one doing all the
Exactly.
crazy stuff.
Gold maintains its value.
And that and like another thing you were talking about was food.
Mm-hmm.
I like to give the example of freeze-dried food for Thrive. And Thrive is excellent food, excellent quality stuff. But when we first started buying Thrive freeze-dried food, a can of peaches was about $18, and you got 9.5 ounces of freeze-dried peaches. Well, today, if you go to the Thrive site, you're going to pay $47
Wow.
for that same can of peaches, but you're only going to get 5.5 ounces of
No
peaches.
kidding.
So I don't know what the percentage of that is, but dude, that's a lot.
That's shrinkflation.
Right.
Yeah.
So, I look at the long-term food storage that we bought as an investment, because I've got that food, and if I can't, like when during the pandemic, when they shut down the grocery stores and they shut down this and they shut down that, well, Stevie wasn't on a diet. Maybe he should have been, but he wasn't on a diet. And so, you look at that and you go, the price of food today is going to be more tomorrow. Plus, you have better control over what you're going to get.
Right.
Back then they weren't slipping in bug flour and cockroach juice
Yeah.
and whatever it is.
Red dye number 6. Yeah.
All this healthy stuff. So, at least if you buy it today, you're going to have some control over what you're going to eat
Exactly.
versus, what they want to feed you tomorrow.
Exactly. And Steve, that proves the point of allocating your assets across different types of asset classes. Even within these commodities that we're talking about, gold is great. Like I said, it's great for a hedge, but guess what? You can't eat gold.
Right.
So that's where the diversification aspect comes in. So definitely spread that risk out as much as you can, allocate those assets the best way you can, and you'll be okay.
Well, that's all the questions I have, and I thank you, John, for being here. I hope you guys enjoyed the presentation or the show, and I hope you get something out of it. And we appreciate you being here, and I hope you have yourself an excellent day.
Right.
Thank you. Thank you for listening to our interview. We have provided links below the video on our YouTube channel and on the resource tab of A Catastrophic Event on everything we discussed in this video. Please remember to like, share, subscribe, and leave a comment on this video, and thanks for watching.